In this video, guys, we're going to look at a quick beginner's guide to short selling. Stay tuned. Hey traders, warm welcome to right. So traditionally, you'd have two options available to you, right? You either buy and the market goes up, you either buy, market goes down, or you stay out of the market. So unless you think the market's going up, you're probably not going to buy, right? You're probably going to go, you know what? I'm not going to buy. I think the market's going lower. I'm going to stay out of the market. Now, with short selling, you have a third option. So you've got buy, stay out of the market. Now you can sell short. And what selling short does, it allows you to profit from a fall in price, regardless of the asset you're looking at. So crude oil, NASDAQ, Dow, Tesla, anything, currency pair, Euro USD, even possibly Bitcoin. Some brokers are allowed to do this. And what this does, it's basically saying, hey, I think the market's high. I think the market's going to go lower. I want to sell short. Now, one thing to say, guys, this is open to active traders. And yes, there are some hedge funds who will hold shorts for multiple years, but you have got a cost to holding the short, which we'll look at in a moment. However, for you and I as retail traders, it's this kind of thing you're looking for days, weeks, or months, that kind of window. If you're looking at years, you probably want to look at other vehicles to do it with if you're looking to profit from a kind of fall in price, maybe a long dated put option or something like that. But that's by the by. So how does it work? If you're using a spread betting broker, very simply, you're opening your ticket, you're hitting sell, and you're saying, hey, I'm betting on a down move. £10 a point, every point it goes down lower, you're making £10. Every point it goes higher, you're losing £10. Spread betting is only available to specific people in specific countries. CFD, very, very similar. It's a contract with your broker. The contract just says, hey, I want to sell this short. And basically the contract just says, hey, I want to pay the difference between the price now and the price when I close it. And I'm taking the downside bet. So in other words, if it goes down, I get money from the broker. If it goes up, I have to pay them. Fine. But let's think about how it works from an operational perspective. Because often people think, well, I don't get it. Selling short, how do I sell something I don't own? And that's the kind of thing I want to talk about very quickly and hopefully become clear in your mind. So we have a scenario where, hey, I want to sell something I don't own. You need to borrow that. And this all happens behind the scenes, guys. It's not something that we can think about, but let's run through it quickly. You want to sell a stock short. You want to sell 10,000 shares short. You would go to a pension fund, via the broker, all automate this kind of stuff. Pension fund goes, or any fund, I've got a 20-year outlook on this. I don't care what these guys think is going to happen the next year. Fine. Here, borrow some shares, but you have to pay me each day. Small amount each day, because it helps my return. You know, I've got this for 20 years, I've got the dividends, I've got the growth. I'll give it out, I'll loan it out short, and I'll take some money from it as well. Fine. Just an extra way of boosting the returns for the fund. You say that's okay, I'll give you however much it is per day. Sometimes it's an awful lot, guys. Sometimes it can be, you know, really expensive, almost 100% a year on some real crazy stocks. Other times it's a few percent a year, sometimes even less than that. So you've got to be careful. That's why it's not really a long-term vehicle, because of the cost that you've got to have to borrow it. So anyway, this fund says, hey, there you go, there's your 10,000 shares. You say, thank you very much. I owe you 10,000 shares. I'll pay you every day. I've got these 10,000 shares. You go into the market, you sell those 10,000 shares. Let's say it's trading at $1 a share. Bang, you get $10,000 in your pocket. Great. Now you've got $10,000 in your pocket, but you owe that fund 10,000 shares. Now let's say the price goes lower, bang, it's now 50 cents. You go, great, I'll buy those 10,000 shares back, cost me $5,000. I've got my 10,000 shares, give them back to the guy I loaned them from. He's happy, I've paid him a little bit of interest on that. I've made $5,000 on the deal because I've had to buy them back. I bought them back and it's cost me half as much as it was when I sold them. If it went up by double, then obviously I'm going to get stung that way. I still got to buy the shares back to pay back the other guy. Now that is a operational thing that if you're selling shares short on the exchange, that's what happens behind the scenes, and sometimes you can't borrow the shares, etc. But if we're talking about currencies, talking about indices, talking about CFDs, spread bets, any of those kind of things, this is irrelevant because they're just taking the market in between the two. They're saying, hey, Mark thinks the market's going lower, Jim thinks the market's going higher, Bill thinks the market's going lower, Joanne thinks the market's going higher. Let's aggregate all that together and work out where our risk is, and if we hedge that in the market, we can do. So really all you're doing is you're betting on a down move. Think of it like that. If you're selling short, you're betting on price heading lower. And depending on whether you're using a spread betting vehicle or a CFD vehicle or a traditional share vehicle or a futures contract, will depend how much money you make for every kind of increment, tick or pip or percent or cent the price moves lower. The bigger the position, the more you're going to make. Smaller positions, the less you're going to make. But also there is a downside to that, of course. If you're selling short, the market goes higher, you're going to lose money for every kind of step it goes higher and higher and higher. One thing also to bear in mind, guys, short selling your losses are unlimited. If you think about why that is, the chart can only go to zero. The chart can go up into the stratosphere, and it has done before. Many times people have been stuck short by absolutely crazy moves and have been hurt. Just something to think about. If you're trading in currency pairs and stuff, the risk is probably the same on both sides because of the leverage you're using. If you're shorting a stock and you think, oh, that stock's well overvalued, you start shorting it here, it can easily go up 100%, 200%, 300%, 1000%. It can only go to zero. Now that's something just to consider and just be aware of when you're selling short. The losses are unlimited, but hey, if you're picking the right asset, you're mitigating your risk. You're not picking very, very small cap stuff. There's very low liquidity on this kind of stuff. You probably have a very slim chance of that happening to you, but it's something to be aware of anyway. All right, guys, that is a new trader's guide to short selling. Take care. See you next one. Bye-bye.